Welcome to Real Estate Accredited. We're going to be shifting gears a little bit and focusing going forward a little bit more on just heavily on educational aspect of things. Not really with the networking aspect. It's just if somebody wants to network, we will do that. But we're just going to focus mainly our efforts on educational platform where we can repackage this information, put it out in a blog for people that rather read the information and use it on different platforms. So just heads up, some of these presentations would be blogs where folks can get the information and read it for themselves. Without further ado, Philip, go ahead and take it away, please.
All right, thank you, Jeff. Yeah, Rajiv couldn't make it tonight, this evening, but it's going to be interesting. I know I have a few students who said they'll join. I will see if they're going to join us. Welcome as well to Real Estate Accredited. Jeff and I, we are part of Boost Capital Group. We want to share education about in-place commercial multifamily value add. And today, I guess the title is a little bit misleading, but it's about how is a deal doing. And if I go to the second page, what can you do if the deal is not doing well, right? If it's in a tough spot. So from that standpoint, we're going to look at four sides of things, like the overall performance, the debt situation, what action you can take, and then what outcome is to expect for the investors. And if we go to the next page, I did it in a quiz format. I don't know, Cedric, you're very welcome to participate. Oh, we have Paula in the waiting room. I'll make you, Jeff, co-host. There you go. All right, somebody's coming. You can let them in.
Okay.
Paula, thank you for joining us. As I mentioned.
Yes. Hello.
Your number one fan.
Amen. Always.
You had.
You gonna say hello?
Jeff, say hello.
Oh, I'm sorry.
Yeah.
I was reading something. Sorry. Hey,
It's
hello.
okay. How are you doing?
Doing great. Thank you. Paula, before you came on, we were talking about shifting gears a little bit, just focusing on the educational part of things in this meetup because we realized Thursday night at 7 p.m. people have a lot going on. So we just want to get the information out, let people absorb it, but we want to follow up with maybe putting some of these into blog format, something that people can read at their leisure. So just something we just want to put out real quick.
That's good. That's good. So what are you guys going to discuss tonight?
I told you earlier.
Well, you told me, but Jeff didn't tell me.
You missed the introduction. You're a little late. What do you want me to tell you?
Oh, man. Well, sorry. I got here as soon as I could. You were eating. I was eating.
Yeah, it is. How is the deal doing, right?
That's right.
And
who is on this call? Who is number 4?
We have Cedric here, but he's very quiet. So I guess maybe he cannot.
Cedric, can you say hello? Where is he from?
We don't know.
Cedric, where are you from?
I'm from Philadelphia.
All right. Ooh, I've been reading about
Thank you,
guys.
Cedric.
Sure, no problem, Philip.
All right.
Glad you're here.
So yeah, how is the deal doing? And we're going to look at from great to terrible, right? And just to show you how I designed this, if I move here, for instance, from a performance standpoint, we're doing better than pro forma, right? Which means your debt coverage ratio is going to be in good position. So above 1.25. Action to be taken. There's really nothing to do at that point. Just carry on. And what's the outcome? Total returns. You're going probably to do better than the projected returns. And I just want to show you one or two examples. And after we kind of walk on a kind of a quiz type of format. Now, let's say the second scenario is you're in line with pro forma. right? So
Mhm.
the SCR, you're going to be at the requirement 125, meaning, again, I don't know, Cedric, how much you're familiar with the concept, but debt coverage ratio is going to be your net operating income divided by the debt service. And to be in a good position, you want to be that ratio to be above 125. But usually you're going to try to push the amount that you borrowed from the lender to the maximum allowable, which general guideline is a debt coverage ratio of 125 versus your underwriting. What you have to do in that case, same thing, just carry on, you're in good shape, and you're going to hit your returns.
So Philippe, I have a question.
Sure.
If a lender allowed in Dallas a DSCR to be 1.2, which is worse than other areas, what is that saying, and why would they do that? Because
It's worse, but the market is so strong that they are comfortable with lower DSCR ratio.
is that because competitively, if they don't do something like that, that lender may lose that business? Is that why?
I'll speak up.
Yes,
ahead,
speak up, Cedric. Teach me. I need to learn.
It could be their business model. Like you said 1.20 is worse. It's not necessarily worse. They're saying that as long as you're 1.20 above the debt, you're fine. In my eyes, that's actually better, which means
Well,
that you don't have to cover 1.25%. They're saying, hey, look, just cover 1.20 of the debt.
But in that equation, that would mean that I, since the definition is I over debt service, that the numerator is less. So their net operating income is less. Am I correct?
And I agree with you there. I do agree with you 100% there. However, the lender, you have to look at it from the lender's perspective.
I see.
That if the lender is saying that all I need you to do is cover the rent that you bring in is 1.20. That's all I need you to cover. So you're fine there. But if you you have to cover 1.25, which means you have to bring in 0.500% more with your rent
I get
to
it.
be able to cover the mortgage on that loan. Okay, which means you got to bring in a little bit more from the rents that you are collecting in order to qualify for this loan. So the 1.20 to me, and I'm pretty sure Philippe and Jeff could agree, that's a little better, yes. And I agree that the NOI would be a little less. However, I'll take the 1.20. If any lender is out there saying, hey, I'll take 1.20, I'm like, okay, I'll do your loan all day.
Now this graph here coupled with loan to value, that is something that I don't know that they mentioned, but very interesting.
But it's a good, is my go-to small balance loan from Freddie Mac requirements. And I think, what you can read is exactly what you mentioned, Paula. And I'm using 125 for standard markets, which are a lot,
That's our standard.
lot of markets. But top markets, they will be a 1.20. And top markets, I don't know if it's in this document.
I've never seen this website, by the way. Thank you
I
for showing it.
must have showed that to you already.
Optico?
Yeah, no, it's really it's the new fancy name for the small balance loan from Freddie Mac. Optigo. I don't know why they went with that. But anyway, and I think it's a factor of risk, really, for the lender, right? You're in a top market, there's less risk. If there's less risk, DSCR or DCR is going to be lower. The requirement is lower. So that's better for you, as like Cedric is saying.
Oh, yeah.
Absolutely. It's better for you. Now, you can choose to be more conservative in the way you underwrite things and so on. But from a lender standpoint, very small market, and maybe I forgot. We have people coming in, Jeff. You know,
yes,
if you want
Adriana's
to.
trying to come in. She just asked me to ask you guys to let her in.
Yeah,
sure.
Jeff, keep an eye on the participants on the wait room. I'll let them
Very
in.
good, thank you. So that's really important to grasp. That's pretty much the standard on that website, right? And that makes sense for the big, because Dallas has got every business coming to Dallas.
That's right.
It's just
That's
crazy.
right. Yeah. And that's really like the top markets are going to be like the very, very big cities, pretty much. And you will know, just as a side topic, that they will look at two things: is the maximum loan to value as well as the DCR, and it's going to be the higher of, or I guess depends how you look at things, but either they will look at both, and it's going they're going to make sure that however money you'll get, it has to hit both requirements. Let's put it this way.
So your top market would be like a Dallas,
Mm-hmm.
and then the small markets would be a small submarket tertiary city like Abilene, or that little white settlement outside to the west of Fort Worth.
Well, probably not. No, because you're in the Dallas MSA in that case. So you're in the Dallas MSA.
Oh, okay. So if it's a small city in the MSA, then
let's look, because I have the list.
Oh man, you have to blow her up for us.
Well, Abilene is not even showing up. I guess maybe it's by state.
Yes, because that's Alabama.
Okay, so very small. So very small indeed. And let's do
you have it by county. Abilene, very
white
small.
What was the other thing? White something? The other
white
city?
Settlement. It's
right
it
doesn't show up
Worth.
Because let's see about Fort Worth.
Fort Worth will definitely show up, and probably in the Dallas MSA.
So that's by county, actually. Oh, look at that. In the Collin County is standard. Dallas County is top. So it depends on the county. So the green is standard. So some of the counties that are top, some are standard.
Yeah.
That's interesting.
It's north of Dallas.
And I'll just say this, and I'm not as familiar with what you're showing, Philippe, but what I can tell is that they're also going by zip code.
Okay.
They do, yeah.
So it also, because see Dallas at the 48251, but then you also see them again at 48257.
Is that what that left margin is right there? That
actually
the 48. I don't know my zip codes outside of Austin. Austin, I know them exactly.
No, it's an ID. It's an ID.
It's not a zip code? Okay. Some kind of state number.
I think.
Okay. Very cool. It's internal.
Yeah, I think maybe, but normally most people would know their zip code. But if that's nowhere near your zip code, Paula, then
we're looking at property there in all those areas, Cedric. We're going to do another road trip, because it's amazing what you find out by getting in the car.
I totally agree.
Yeah. All right, let's go back. Let's go back to this, if you don't mind. So we covered so far. You didn't, hopefully, or it was interesting question about the DSCR. I use an average standard number in any case. But now, so what's the next? We're going to best to worst. Okay, so now, obviously, we're lower than pro forma. So what does that mean from a DSCR standpoint? I want to make this a little more interactive.
So sad.
What does it mean from a DSCR standpoint?
Less.
I agree with Paul.
Going down.
Less. Okay. Correct. Congratulations. So what do we do now? That's the real question. What do you think we can do? You're the GP, you're in charge, right? You're the sponsor of the deal. What can you do what is the first thing you should do? Or first and second thing?
The first thing I do is pray. And the second thing I do is collaborate with my partners.
Okay, that's a little bit too generic.
Just saying, telling you what I do.
So at this point, you're going to look at one, I would reevaluate my numbers or confirm my numbers to make sure that they are spot on. But if not, if the numbers are correct, let's assume they are correct. At that point, you're going to probably have to add in maybe you're not going to stop right here. You're not going to stop right here, but you're going to be able to evaluate a little bit more.
Okay, but that's not the first thing I would do. However,
Okay.
it's part of the things. Absolutely, it's part of the things.
Can y'all unmute Adriana if you haven't done so already, please?
Sure.
We have to okay.
Thank you.
Here is what. Oops, I guess.
And
So now, it's not doing as well, the deal. At that point, you're gonna have to stop the distributions. If you're making, which means usually there are distributions, obviously, but it's not going as well. This is and actually I should have put that the first, use the reserves. Obviously, you should have some reserves, but then stop distributions. Yeah, step 1 and step 2, right? Use the reserves to carry on, and maybe there's some you have a little bit of wiggle room with the reserves, right? I know, Cedric, if you're talking to us, but you're muted actually. Okay.
Adriana is muted and she wants to be unmuted, and I am unmuted.
Can we cannot unmute her for her.
She's already able to unmute herself.
Yeah.
Yeah.
I see. Thank you.
You cannot.
You have to unmute yourself. I would do that, Philippe, but I would make sure that there's nothing else that the partnership hasn't left unturned, because I'm new at this, right? So I would want to make sure, looking at the NOI, is there anything that we could have missed? Now, time is of the essence, right? So you have to pretty much make a quick decision. Am I correct?
Yeah. And what Cedric said is 100% correct. It's like, start using your reserves, stop distributions, reassess your budget and whatnot.
Yeah. Anyone who's
Because
been through a
is
capital
there
call gets
take
upset.
corrective actions? Is it like a big thing, etc.?
Yeah.
And go ahead.
Now, I'm sorry. I would just say at this point, you might even want to stop renovations.
That's right. That's a good point. Yeah.
I would add it.
Yeah.
I would not know it otherwise.
Stop renovations. See, that's good. We're collaborating on this.
So when you say that, Cedric and Philippe, that means that whatever you're in the middle of, finish it up and don't do any more.
Yeah.
Because
Slow
you really
down.
need to look at
Stop the expenses.
Yes. Make the bleeding stop.
Which is not, we're not in a terrible situation. Like things are slowing down, right? So you have to start looking at everything and take like step by step. Obviously, it's a bigger picture. So what does it mean in terms of returns and outcome? Obviously, now if you stay there, you're going to have your projected returns are going to be, sorry, your actual returns will be less than your projected returns.
Okay, so elaborate a little bit on this reassess budget. Be more specific about, say, your planned CapEx. Say, for instance, you had not signed the contracts to do certain things, but you know that you're going to have to stop renovations. And so what you're saying then is you would reevaluate maybe some of the things you had planned to do that you're not going to do anymore based on the market. Am I right?
Yeah, but it could be maybe, yeah, some of the services, like go through the whole budget again with your PM, with your property manager to see, is there anything we can cut? Is there anything we can delay? Is there anything we can do less of without impacting, which obviously the top. And now actually we could do a whole session about this. It's like how to improve the budget. And maybe that's a good idea for the future. I'm gonna make a note of this. Otherwise I'll forget after.
Maybe. Are you
We
hearing me?
check to reassess it at certain times and then make sure that you're checking it anyway. Hey, you're mobile again, kid.
Yeah.
It's okay.
Take
I'm
it on
gonna
my
go to replace an
Alright.
HVAC in an hour, so I understand.
Because so now one of the issues, the question is it a top or income problem or bottom with expenses?
Yes.
Because you're going to do different things. It could be, I just had some issues in a property in Memphis. And what happened is some of the units became vacant because we had delinquency and evictions and whatnot. But then we couldn't fill the units really, right? And sure, like this is a terrible time of the year to rent anything because nobody's moving in or out. We're basically in a holiday season, so everything is shut down. And I think now it's starting earlier and earlier. After back to school time, pretty much, it starts to slow down, but November, December is the worst. So we ended up doing concessions. 1 month free. Now we did a honey ham gift card with
Really?
the regional suggested. Yeah, she had a nice, I closed my other browser, but she did an illustration like get your $100 gift card, like honey gift card for
It's
Thanksgiving.
perfect timing for Thanksgiving.
Exactly.
Yeah,
I mean,
that's a good idea.
Yeah,
Yes.
yeah. And sure enough, we filled once we find a good price point, we filled all the units. Again, we'll do a session. It's a very good topic.
So one thing that in regards to reassess your budget, also if you can't get the place rented because turnovers are not happening because maybe the contract company is not getting their paychecks, so they stop working. So there's things that fall through the cracks that do happen.
You talking about the people that lost their jobs, you mean?
No, the contractors, the contract
Oh,
company.
the contractors you hired?
Yeah. If the property management company is not paying,
Oh my
they
gosh.
stop working. No units are being turned over, so there's no new tenants. So
So do
affecting
you
the
call
pro
them? What do
forma.
you do? Do you call your property manager and ask them, are you paying everyone, or what do you
That's
do?
part of reassessing the budget, reviewing
Okay.
all that income,
And use your reserves to make sure. It could be a PM. So is it a cash flow issue if you have a bridge loan where you're getting the financing basically on your repairs from the lender? So the way it works, you're supposed to front the money, get everything done, and then you're reimbursed pretty much. It's like new debt added. But sometimes, like the process, things are being missed, and you have vendors are not being paid, and now you run out of cash, really. So you're really waiting for the next draw from the lender to move on. So so you have to be creative.
You know
Sometimes
how
inject.
my guy GP was my general contractor was creative. He showed up with a wad of cash, and that's how he was creative.
There you go.
They showed up. Up.
So next, I have 3 more nuances of this, and then another slide I want to go over. So and after the different variations coming up is going to be the DSCR basically becoming worse and worse, to make it simple. So now you're in a position here you were things that were slowing down. It's not terrible, but slowing down. But now you just have enough to pay your debt. And now you have to look at different options. Right.
This is pointing out that you're in a 1.25 contract, but you're just coming up with 1.05. essentially.
Yeah. Yeah. So you're barely paying, and at any time you could be under the water. So hopefully when you start to get slower, you stop your innovation, stop distribution, you preserve cash, right? You're not in a good situation. Now you're getting close. So hopefully you have enough cash to curb the situation. But for example, if you went in with a variable rate interest rate without a rate cap, or the rate cap expires, for instance, on a bridge debt, you can easily be here or in one of the following situations, right? So then what? I think at that point, situation is close to becoming dire, if not being in a dire position. So what are your options?
Call,
Yeah,
cash call.
yeah, that's one of them.
Yeah.
It's called, yeah.
That's good. That's good.
To
Capital call.
vote to bring some other people in to change
Yeah.
your
Oh,
agreement.
That's
Bring your
two.
own,
I
maybe
think I
bring
have
more-
four.
Bring more
Go ahead.
equity.
Yeah, yeah, same thing. Yeah, bring
What
more
else did you
equity.
say, Adriana?
Bring
She-
equity.
It's the same thing you said, Paula.
Same thing. Same thing. Just
I have
different
two other
ways to
things,
do
I
it.
think, here. 2 or 3.
Okay, let me think of what's happened to me. Let's see, call.
You're going to use, at this point, you're using all of
Oh,
your reserves.
refinance.
Yes.
There you go. That's one
Yes.
of them. That's one of them.
Okay.
So what's number 4, Philippe?
Sale, maybe sale. I don't know.
Yeah, that's coming.
Yeah, but that's
Refi.
that's a fire sale, right? That's not good.
Refi. See, so now
Yeah,
because
she said that.
refi, well, somebody can lend money to the deal,
Oh,
right? So
so
it
to
could
go
be
to
the
your
GPs.
equity GPs.
GP look, and that's why after everything is and or capital call for your LPs, your limited partners, or you bring a third party equity group to bring money. And here, because let's say in the case if you had the variable rate and now you can refi, the deal is doing okay, but you can refi with permanent debt agency, right? They may ask you to rebalance the DSCR pretty much, or the loan to value. And from that standpoint, they want more cash.
Yeah.
That's why you need to bring more capital, right?
So
it's
in
a
this
very
case, who will be the third party that will bring capital? Who will that be?
It would be you and me,
well.
Adriana.
There are groups out there.
Third
There are
party.
groups out there who are start to talk about this. I know Good Egg is, for instance, Good Egg Investments. There are other groups. I've seen some emails floating about recapitalization.
Ethan Gal would do that. It'd be hard money, but
It's going to be private groups in a more.
As Paula said, private money, hard money.
I have a question.
Yeah, the hard money. I don't know about hard money if they would be ready necessarily to stay for that length of time, because it could be 2-3 years until.
Yeah.
But it could be just to carry you over until the refi. They could do like a year long.
Exactly.
Yeah,
Carry
yeah.
you into that refi kind of like additional.
Because
Yeah.
your agency is going to be an 8-month loan. You have to apply for that, don't you? You have to do a bunch of paperwork and wait. So you're going to need somebody that's up to a year just to hold you over just in case.
See, that's Good Egg here.
So how the third party will like to invest in a property that is almost or already bleeding?
Because, okay,
friendly?
that's a very good question. That's a very good question. Now, actually, you could have a decent pro forma, right? So basically, you're hitting your numbers, like your NOI is okay, but your debt, instead of, right, because we're comparing the debt to the NOI, and it should be like 1.25, right? It makes sense with my hands here. But you could have a problem with the debt going higher, actually, right? I could have said it differently. It's like pro forma is still okay, but debt is higher. So now you're still in the same.
So if you were trying to get a loan and your debt is all of a sudden higher because you have to borrow until that interim period is over, then what are you going to do? You're going to increase your NOI somehow.
Wow.
Yeah.
I still don't get it.
I don't either, but he's typing, so let him have a second here, Adriana.
Okay, so
good result.
this is your NOI. That's my left hand.
Okay.
Okay.
Yes.
What I initially described, and which I mean pro forma, and that's an NOI pro forma, right? Net operating income. That's what I refer to. So what, in my main scenario, I have this is my debt on my right hand.
Right.
But the initial scenario I described is my NOI. So my performance is going lower, and now my ratio is getting bad,
Similar.
right?
Distorted.
1.05. But I can be doing well on my pro forma on my NOI actually. And my debt is getting higher because I have a variable rate.
Okay.
And I still end up in the same result. My DSCR is in bad shape.
Okay, I get it. So when that other person, that third party comes in and rescue you, what are they gonna do differently? Just maybe bring in more money and then
Yeah. So you see, like good eggs the other way. It's interesting actually. Do they take control of the asset? No. They let the people do what they're doing.
What's the name of the fund, Philippe?
It's Good Egg Pref Fund 1. They're not the only one. Yeah, I just remember that they're doing it. And they explain. I know they did videos and so on. But it's interesting. So some people, they are raising money for that purpose. So their model is, NOI is okay, but the debt got higher and they need help to meet the DSCR requirement.
That is happening a lot right now.
Yeah. So let's carry on with that think or that thought. Right now, a likely outcome, we could be projected returns lower than projected, or at that point you may be like in a break-even situations.
So that's also translated to mean that the GPs don't get anything.
Pretty much.
Yeah, that's right.
They get paid less.
But it can always get worse. I have two more steps.
Yeah.
I
have two more steps, right? So now your DSCR is below 1. So now you have to. You don't have a choice. You cannot pay. So what's your option here? You have to sell.
Yeah.
And probably at a discount because you're in a distressed situation, right? And there've been a lot of talks about this, and you're probably in a bad shape on your pro forma and you cannot pay the debt. So you have to get out as soon as possible. You can renegotiate. And that's probably the first thing here. Negotiate with lender an extension of some kind.
Ka-ching.
Yeah, exactly.
Mm-hmm.
Yeah, everything will have a cost.
Mm-hmm.
I'm going to get rid of this. Yeah, negotiate. Next step, sell. So what does that mean for the total returns? What's the outcome?
Man.
Now you're talking about partial loss of equity, potentially.
For all your investors.
For your investors. So now they invested 1. They were expecting 2, but they're going to get 0.7 back or something like that.
Yeah, maybe you should put that for investors on there, Philippe, so people like me will understand that they're not going to be liking me too much. This is where we're reminded to say the words forward statements.
Yeah.
Yeah.
You're on mute, Cedric.
Okay, let's pretend you didn't see
that. Yeah, I'll just say, like, right there, the partial loss of equity is a little misleading because the partial loss is the projected returns, the partial loss of projected returns. The equity is actually what you put in.
Yeah, but that's what I mean. Here, you're losing your shirt here. And for now, it's just a sleeve. I'm not, I understand what you say, but I am purposeful with what here I'm saying you have to sell, you sell at a discount, you're not in a good position, and the likely outcome, investors, you're going to return 70 cents on the dollar to them at that point. They're losing part of their equity.
Okay, I'll go with that. All right.
Philippe,
And of course, just I understand what Cedric is saying. It could be you're breaking even, and that's a good outcome. Or you're making a little bit, right? But that's a possible outcome. That's probably like a possible, right? It's a possible outcome for investors.
but at this point in time, when you say that you have partial loss of equity, you're going to your LPs and you're putting that in newsletters periodically. But all before that, in all the previous communiques with those limited partners, there should be communication about what is working or not working.
Yeah.
Because if you don't have that, then when someone is at the point where you're saying you're going to lose some of your money, say you put in 100, you're going to get 70 back. That's when, if they weren't paying attention, they're going to be going back to those old newsletters and saying, where is it? Where was there to sign? And if you don't have it in there, they're going to be calling you. I know, because I was one of them. And you're going to say, okay, where's the money? What happened? And before I knew better, that's one of my first deals where we had a call, and it was just like that. And they said, you're going to either put more money in or you're going to lose it all. That's what their communique to me was. So we had a call.
Yeah.
And another year later, we sold.
Okay.
But there's no, at that point, their magic is gone. It's dire.
So what's next? Now it's part, right? So now you're even worse, and you're in a DCR, so you cannot pay your debt.
Okay.
For more than 6 months.
It's a fire sale at this point.
You're going to foreclosure.
Bye, Felicia. No more.
You're handing the keys.
Okay, that's
and at that point, there's nothing left. It's a total loss of equity.
Hey,
they don't want it back. You're selling for deed in lieu, or you're just saying I messed up, and then you're never going to do business in that town again.
Quick question, Philippe.
Yeah, Adriana.
When that happens, I don't know if you ever experienced or know what happens. I've never experienced that either. When a property goes for foreclosure and you still have tenants in there, what happens? Who takes over? What happens? It's the whole procedure.
The bank. The bank becomes the owner.
Right.
They don't want it.
So they'll have
their own brokers too.
Yeah, they will. It depends who it is. I heard recently a case where the bank was like a very small lender, apparently. They took ownership of it, and where they were running it. Like a larger lender, I would say they would probably sell, like Jeff said, they have their own broker, they would sell it at a discount, whomever
Yeah,
is.
but meanwhile, who's taking care of business? That's my point. Who keeps collecting rent? Who keeps on doing maintenance? What happens throughout that period between the foreclosure and selling it to someone? What happens to their whole...
But it's going to be whomever has the keys. So if it's the lender who has the keys, they have to get. They don't have a choice.
Management company in place still. They'll still have to work with them.
The bank calls the brokers and tells them.
Yeah, and it's going to probably to be, look, it's going to be announced for so many days prior, right? So there will be somebody who will be able maybe to take over at the day of or day after, whatever foreclosure. That's a good question.
They
good
bring
question to ask a lender.
Do they bring their own management? Does the management stay in place, or they bring new people? I would love to know that, just because I'm...
but that's going to be, it's like when a new owner is taking ownership. So sometimes it makes sense to to start
Bring
fresh,
on.
sometimes it makes sense to keep the people. It depends.
Okay.
Hey, Jeff.
Yes, sir.
Yeah, go ahead with your explanation, because your explanation was definitely spot on.
I think I was going in regards to depends on the ownership. I don't know if that's what you were talking about, but the bank would definitely take over and have to make sure that the property management company and whoever there is working on as part of the deal will stay in place. And it depends on the lender until they either have a broker that's shopping for a buyer or they have already a buyers on speed dial, the little black list that buyers that they know are real legitimate buyers or have cash to close these deals, they'll start calling those. So that's where they get those deals at pennies on the dollar. So
Right.
that's essentially what would happen. But Philip was saying it depends on the lender, the size of the deal. There's a lot of situation
Variables, yeah.
Yeah,
I see.
variables in the
Thank you.
situation.
Which actually, it's a good segue to my next and final slide. I know we somehow took a long time, but I think it was good. Happy. Thank you for the interactivity there. So this slide here is coming from the presentation that Yardi Matrix has done, their multifamily national outlook fall 2023. So it's from September 20th. If you go online, you can find, I don't have the link handy, unfortunately, but if you go type these keywords online, Yardi Matrix, multifamily national outlook, there is a webinar replay you can watch. A lot of slides and charts and so on. But one particular slide caught my attention, and they're looking at finding opportunities and particularly distressed opportunities or getting there. And if you remember, I used the DCR or DSCR, same thing, lower than 105. So meaning that you're very close, you're barely paying your debt at that point. So it's possible that you're going to be even in a tougher situation. And really, only, and I say only in the big picture, 2,500 of properties, more or less, in that situation based on that company, with gathering a lot of data from the real estate market, because they also sell a property management software. It's part of their portfolio. So they're gathering a lot of data pertaining to the market. So even if you 25 or 3,000 properties out of 115,000 total, there are only 2.6% of all properties that are in that situation of a low DSCR, meaning that close to be in a tough spot, and basically in a position that they would have to sell probably in, it could go the SCR here. They have many options actually before they go to that they have to sell or go to foreclosure, right? They could do the refi, the GPs can lend money, etc. You have all these different actions that can be taken before you really have to sell, and then somebody is really going to have access to a very good deal, like we discussed earlier, and with the lender taking over and whatnot. So this is let's round it to 3% of these properties before they become in a very dire situation, and like the Houston foreclosures that we've seen earlier this year. There are many things that the GPs can do to curb the situation and save, either lower the returns or break even for the investors or lose a little bit money. There are many things that can be done at that point. And there are only 3% that are the very top of that whole stack of different layers of direness, if it's a word. Which shows, I think, so looking at the other way, so that was from looking at the opportunity standpoint, so not that many, but I would say use this when you talk to investors who are a little bit worried. They say, oh yeah, I read that newspaper on foreclosures and this and that. The reality of things is there's only 3% of properties that are in a situation that is nowhere close to foreclosure. There's only maybe like 10% of those. So now you're looking at 0.3 properties be really in a very bad situation, right? So that's the key takeaway.
Have you seen the distressed properties going through your desk already?
No, that's why. There are not a lot of them.
I have seen at least 3 or 4 in the last 6 weeks.
We're looking at different markets.
Yeah. So I've seen a couple in San Antonio, one in Lubbock. I've seen at least 4. And really distressed, like the prices were cut down to 40%.
Oh, wow.
40%.
Hello.
Yeah.
We're going to see more, guys.
I don't know.
It's true because I was talking to a guy in, where is it that we were last?
We were at Old Capitol, and that's where the bankers were lined up and saying, we keep calling them.
Dallas, and I was talking to this broker, and he says, I don't think we're going to see many more of those distress. I think this is just about to be it. I'm like, really? Yes, yeah. So I don't know.
Yeah.
Because
again, so the sell, you're in that position here, right? So you're at the DSCR, you're trying to sell before to avoid foreclosure. So again, but the whole amount is not that big. There will be some, for sure. And maybe some markets are
more than others, yeah.
Yeah, more.
Some that don't even make it to marketing. Some that are sold behind closed doors. And then you got to think the lenders started tying up their belts a lot quicker with these interest rate changes. So they did a lot more due diligence after all these big reports on these deals that started failing because of the deal size is what caught the attention. It was just the amount of units on these deals that are newsworthy to create hysteria. Failing banks. It's only 3. There weren't even banks that would really have that effect on a huge economic level. It's just news.
And again, you see here, and I understand maybe there are some, but I would not focus my whole strategy. I wouldn't focus my whole strategy on going looking for distressed assets, because the volume is not going to be there. That's the thing. Again, if you have, by all means, it could be worth it for sure. But then, by the way, if it's really distressed, then you're going to need a bridge loan, and now you're back to, so you need a cap and so on, which I would say, as we discussed in another Thursday call a few weeks back, it's likely that interest rates are going to be lower, but who knows? Who knows what can happen?
I think they didn't bring it up yesterday. It's a good thing.
It's possible there could be another black swan event or whatever, and then you're back to higher rates.
Yep.
And actually, we were playing with some shorts last time, and this is exactly what we spoke. There was Paula on the thing. I don't know if you can hear.
Yes.
I would say on the same train of thoughts, avoid refi in the initial business plan, because a refinance, you just don't know what the interest rate will be down the road. You don't, but you can make all the assumptions you want. We pull a chart of the interest rates of the 80s. I don't think they were expecting to have interest rates in the 15%, but it happened. Were people expecting that, Paula?
Yeah,
Yeah.
I remember 20.5%. That was.
25, what year was that?
That's it.
I just sent Philippe picture up to as a
So Paulita,
Text.
what year was that, or 25%? What year was that?
20.5.
yeah. So anyway, I sent that to you, Philippe. You can look at it about since March of 2022, how many increases the Fed has had. And when Mr. Bawa was at Old Capitol, Adriana, correct me if I'm wrong, he said there's going to be maybe 2 more raises, and then they're going to start coasting and going down.
Paulita, do you hear me?
So, no, I'm sorry. What did you
What
say?
In what year was it really 25%?
Was what 25%? I didn't hear it all.
20.5% interest rate.
Oh gosh, 20.5. That was probably around 1976,
Oh,
77.
okay. That's why. 'Cause I was
While you were
barely
a
born.
twinkle in your dad's eye.
Yeah. Because the most I saw was 10, almost 11.
Oh man, you're good. You're gone, Adriana. Adriana, can you hear? We had a loan for student debt for 9%, and we were in hog heaven
Oh,
because we didn't have at that time 9% was low, and everything
81.
else was like 12 to 15%. And that was when I was going to school for the first degree, probably 78, 79.
81 was the higher rates, actually.
Yeah. So yes, I remember. And when I remember stagflation, I remember as a kid, line for gas for 2.5 hours around the corner, line and sitting in my car. Yes. Philippe, did you get my text?
It's in my other browser. It's a text.
Okay. It's on
I
your
have
phone.
to open it. Yeah, give me 1
Yeah,
second.
it's just to show you all the Fed decisions and how much they've pumped up the rates so fast. It's not that they've gone up, it's that they've gone up so fast, and so the market doesn't have a chance to equilibrate.
Oh, you cannot see my screen. Let me show again.
yeah, the market didn't really
Yeah.
have a chance to
Yes.
either.
It's here, but see here, like this is 81, right? This is the higher rates from the Fed, 19%
Unbelievable.
in 81.
Now, if you do the 10-year minus the 2-year,
Yeah, this is
see the inversion.
until now.
Yeah, March of 1980, 20%.
If I'm lying, I'm dying. It was harsh. It took me 10 years to pay off that student loan. I craved it when I got it done.
Now everything's being forgiven.
Oh no, I don't think so. I think they're coming back on them. They're freaking out.
Are they?
They are.
They already spent all that money.
That's
You
very
can't make them
sad.
pay it now.
That's very sad for them.
Yeah.
So y'all, I just heard that Denver is doubling their rental rates. I don't know if that's true, but y'all should probably look into that. And those people are probably coming to Texas or somewhere else.
Yeah,
There it is.
Denver's expensive. That's for sure.
And so October was nothing, right? Zilch. Look at that. They can't even fit it on there anymore. So it's gone up so fast. We'll see. If they wanted to crash the market, they're doing a good job.
Really bad. Hold on.
Yeah, it doesn't have November on there, or excuse me, October on there, does it?
No.
But that'll come back at 0. And that was the morning of, and they were looking at the past history. It's amazing. They're clipping. It is what it is.
Yeah.
And it might be some great opportunities for us.
And again, so the point is, yeah, like compared to 1, 2, 3 years ago, it's high, but there's nothing. It could go higher and higher and higher. Who knows? That's why, in my humble opinion, unless you know very well what you're doing, and I think some people, I respect what they're doing because they have a lot of experience. They're doing that for a long time, and they're doing variable debt with they're buying points, basically, some such as Rise 48. They do something very interesting. But otherwise, I would say you have to stick to interest rates that are fixed, that you can control. it's yeah, we can be in that situation going higher and higher, unfortunately.
I think it's going to go up and then it's going to come crashing down. We shall see.
That's interesting. We have people joining now. But
Yeah.
we're going to.
Hey.
Crazy.
Yeah. So we're at the top of the hour now. Went a little bit longer than we expected, but hopefully it was interactive enough and got some takeaways. Hello,
Indeed.
Sean.
It was very good. Thank you, gentlemen.
Thank you.
Learned
It
a
was
lot.
really good, really good. Love it. Love it.
Loved it.
Thank you.
Sean, are you there? We can't hear you. Sean, thank you for joining. We're wrapping this up for this evening. In order to respect everybody's time, we want to thank you, first of all, and we hope this was valuable. And we'll do something with that information so that anybody that wants it, they can, for their viewing pleasures, they can get it. But until next time, thank you for joining us. And that's it for today.
Thank you so much.
You.
Thank you, everyone.
Good night.
Appreciate it.
Thank
Thank you,
you.
everyone.
Good night.
Bye-bye.
Bye bye.